Hello, everyone. We're going to get started. Thank you all for coming. It's sort of standing room only, and I really appreciate all of that. I hope we can live up to the billing. That's all I can say. So welcome to the sort of the M&A panel. We'll talk about M&A activity and the build versus buy dilemma here. You have a great set of panelists. With me on stage, you have Jason Brein from Francisco Partners, Pranjal Kumar, head of Corp Dev at Emeritus, Scott Kirkpatrick from BrainPOP, and Anthony Showalter from GoGuardian. Madalena from Morgan Stanley couldn't make it, and with that, we will apologize for the lack of gender balance on the panel, and apologies for that. But what I wanted to start this out with was the blurb that you might have seen that enticed you here was as follows, and I'll read it out, which is, in the last 6 months, there has been $4.2 billion in EdTech M&A activity across 72 transactions. While activity and valuations are down from the frenzied environment of the pandemic, there continues to be considerable M&A activity amongst EdTech leaders, with many predicting heightened activity towards the end of this year. So this, GSV gave us this blurb in February. It's certainly, sitting here in April, M&A activity is down year on year. M&A activity is down, Q1 compared to Q1 last year. It's down compared to the last quarter. So generally speaking, in the industry, not just the EdTech industry, but across industries, M&A is down. The reasons for that are fairly obvious. But having talked to the panelists here, I sort of asked this question in a provocative way to say, well, how is EdTech different? Or how, even if it's not different, how does it fit that storyline? And what do we think actually the next few months holds? And I think you'll find some interesting answers here. So Jason, do you want to start us up? What do you think about that sort of blurb? What do you think about the levels of activity? And kind of take us through your perspective on where we are today, how we got here, and where do you think we're going?
Thanks a lot. So yeah, M&A levels are down over the last 12, 18 months. But 12, 18 months ago, that was a unprecedented level of activity. And if you look at actually the activity relative to any other active environment, 2018, 2019, first part of 2020, volumes are at a reasonably healthy level. So one question is just like, how did 2021 happen? Like, is maybe one way to start it. Combination of, and I think this is like just generally widely known by many, but one, unprecedented fiscal stimulus. Two, cumulative impact of 10 years of effectively free money. Three, in education specifically, a lot of sort of market-specific tailwinds in K-12, the proliferation of devices in schools and broadband, higher education, the increased penetration of technology and software. There's all these sort of industry-specific factors, and all of that led to a heightened capital, heightened deal activity, and quite the frenzy. We have certainly come off that a little bit. If you look at sort of just general IPO activity, if you're seeing a slew of education companies going public, that's not a terrible sign for we're getting close to the top. And so there's less of that today. But it doesn't mean companies aren't healthy. It doesn't mean businesses don't have healthy balance sheets. It doesn't mean, as investors, we are absolutely looking to deploy money today. And I don't believe anybody here would say, we're in a particularly poor market for capital deployment. It's just not the market that existed 12 to 18 months ago. Understood.
And so, Pranjal, you had a perspective on the market too, and in terms of, yourself as a strategic investor, an acquirer, and in your, prior life, I guess, as just an investor, what do you see the market at? What do you think of the market today? What do you think about that?
No, I think, look, if I wear a strategic hat uh, to this, I think the way I would sort of narrate the story is 2020, 2021 was the story of Playground, where everybody was trying to do M&A. The market was on an adrenaline, right, because of COVID, etc. Bets were made. And I think now the serious players are on the ground and the balance have left the playground. And I think from our perspective and for any serious strategic who thinks of M&A as a core strategy for their growth, this is the best time. Why? Look at the supply side. There are a lot of companies, early stage, mid stage, where they are unable to raise capital because for whatever reason, and Jason did make that point, but I think if you do ask the question in the room saying, okay, how many funds are deploying capital? What's their criteria for deploying capital? How soon they can deploy capital? I think the answer is that the environment is somber. So that's a perfect strategy or a playground for a strategic like us to say, look, you know what, this is perfect because now the financial sponsors are on the sideline and the strategic sponsors can step in, number one. Number two is, as strategic, I think one of the values that we bring to the table is the fact that we don't evaluate the business as standalone. We also evaluate the business as standalone plus what it means for us. So that, again, helps in justifying a business case versus a financial sponsor which evaluates the business standalone. Number three, the valuation expectations are reasonable. I mean, 2 years back, they were crazy valuation expectations. Not just valuation expectations, even the mix of currency is reasonable, right? Earlier there was all cash, cash, cash. Now it's like, okay, you know what, we're happy to do cash plus equity, right? So I think if you put all of that together, and I've spoken to some of the founders, we've done some M&A in the past, one of the key drivers for a lot of founders to think about strategic capital is the fact that if you allow them the freedom to run their ship, but give them that cover to say, look, you know what, we as strategic would not let you down, and we understand the ups and lows, and we will provide you with relevant capital, but of course push you and nudge you in the right direction. I think the founders, that narrative is resonating with the founders now versus 2 years back when everybody was trying to do EdTech. So I think from our perspective, this is a perfect opportunity.
Thanks. And so, Scott, you were nodding at that as well, and I think you had similar themes of sort of, take us through your experience with M&A and how some of the themes that Pranjal pointed out to kind of resonate with you.
Yeah, and I believe from the market perspective, just to add on to these guys, is the pandemic took us 2 steps forward and then 2 steps back. From obviously what Jason said about the infrastructure and the connectivity and the hardware and the teachers' understanding. And I represent more the K-12 side right now, but I'd done deals in higher ed as well as workforce readiness. But I would say in the K-12 side, you have these good news about teachers knowing technology, but then obviously the mass exodus of teachers, the decades worth of learning loss. And so what that is really requiring is systemic change in the K-12 space. And what you're going to see is so much more scrutiny. It will no longer be a free-for-all. You're going to see a lot more actually scrutiny around what kids are getting. And that's where that's going to stay. And back to the point here is that big brands will win. And even if you think about the impact of technology, content commoditizations, brands probably more important than ever. And when you think about brands, we need to build capabilities on the strategic side. And those capabilities are always going to be through that buy to build lens. And obviously we see the same thing now with obviously valuations down, which giving us a better opportunity to use M&A as really a build strategy. And when you think about, to answer the question on my experience, I've always tried to look at it from a buy-build decision, whether or not on the buy side or the sell side. when we sold, Princeton Review to IAC or General Assembly to Adecco, or most recently BrainPOP to Kirkby, the Lego brand group, it was always in that same lens of not setting the company up for sale, but to make sure that we are executing our strategy and having that real decision point to say, okay, there's these real milestones where part of your strategy is to make that big buy, build decision. And for us at Princeton Review, we knew we wanted to get into college admission, so that's why we made the build buy decision. At General Assembly, we wanted to make a big commitment to B2B versus our large B2C business, and we went the route of partnering with the biggest staffing company in the world, with Adecco. And with BrainPOP, the pandemic gave us an opportunity to go beyond our institutional business where we serve schools and teachers, but also to serve families, and who better in the world to serve families than Lego. So that narrative of actually putting it in your strategy, and even that's on the buy side as well. When at Princeton Review, when we wanted to get into college admissions, we bought then because it was part of our strategy. It wasn't like an opportunistic deal. And I think all companies that are looking at their overall strategy and from the strategic side, they should be making that buy build decision on the both buy or sell side.
Maybe I'll just add to that, right, what Scott said. And I think when I said 2019, 2020, 2021 was a playground, I think in this part of the world, M&A was always a strong lever of strategy. But when you talk about Asian players, it wasn't, right? Pre-2019, usually the founders in the EdTech ecosystem would say, you know what, it's organic, organic, organic. I think what COVID did, and to some extent the liquidity that followed on with it did, was it gave them the capital to experiment with M&A. And what we are now seeing is that even Asian players are or Asia-centric players are also now very comfortable with M&A as being one of their core strategy, which it wasn't 2-3 years back. So that's probably one
this is
big
your
lesson.
9-minute warning. 9-minute warning until
So,
we're going to start the presentations.
Sorry,
I urge you to start thinking about how you're going to pitch this idea.
I'm not exactly
maybe
sure.
in
That's
4 or
not
5
us.
minutes.
But
They're kicking it off pretty quickly. 9 minutes, you're out of here.
so anyway, so the clock. I have a clock here that says 27 minutes. So you guys are good. We're following that clock. Yeah, just stay. This is not the Oscars with the music and everything. So a question for you guys. I mean, just to build off of that, and Anthony, I'll come to you in a second. Just a question for you guys. When you talk about consolidation, do you now see this as a US-specific consolidation market? You see it as an Asia-specific? Like, do you see consolidation therefore happening at a global scale now, just from a, verticals perspective? To the point you were making, Pranjal. Do you see that differently than you did maybe 3 or 4 years ago?
Yeah, so look, I don't know if I want to use the word consolidation. I probably want to use the word ambition.
Sure.
And say that increasingly now, I mean, US-centric or North America-centric players have always looked at global as the landscape. But I think what has happened in the last 2 to 3 years is that the players in Latin America, the players in Europe, the players in Asia are saying, look, we can actually be global. So when you talk about ambition, A, global ambition. B, the products are expanding now, right? So they're saying, okay, you know what? I have a certain offering, which is probably in higher ed. Like in our case, for example, it's university-backed higher ed education. How can we expand our offerings? How can we expand our channels? How can we expand our geography? So, the power to think and then the availability of capital, which was there last 2-3 years, gave them the appetite to execute on that thinking, which has now led to this, fulfilling of ambition in some sense. And look, some bets have worked out, some bets have not worked out, right? And the experiments have happened. But if we're in a longer game of building up a large business, I do see that there are a lot more global EdTech players that will emerge because they're saying, you know what, I can't build in that geography because I don't understand that geography, but hey, I can acquire a player there. I can acquire a player there and cobble up and build a large global, base. I think that's going to happen, yeah.
Right. So Anthony, to bring you in here, so Pranjal talked a little about global ambitions, and you know, if you won't use the word consolidation, at least global players emerging from this. Anthony, you've had some experience with a different kind of player and some, you know, the sponsors emerging in the market, and your experience with that. Can you talk us through some of that?
Sure. And maybe just to rewind a bit, I think, you know, I approach this from the perspective of a former operator. I was a co-founder in a business in 2014 called Peridec, which was, you know, 8 years ago we were pitching on the GSV stage. And in 2020, we were one of the net beneficiaries of remote learning. And our business grew more than 5x that year, leading to an eventual acquisition by GoGuardian. So that's kind of the path in which I found myself now in the seat of a corporate development role, looking at K-12 and kind of the, you know, our own best take at the future and consolidation. And for us, we...
Okay, everyone, this is officially your 5-minute warning. I would really encourage you to start thinking about how you plan to present your pitch.
The pause was perfect, actually.
And remember, each pitch is going to be tightly held to 2 minutes max. So make sure you're really tight on how.
This is PTSD, right, from my pitch. This is much more comfortable. So we, you know, the way we look at K-12 right now is definitely a move towards consolidation. There's been a huge proliferation of tools, and really for the first time we're starting to see, you know, there's always been kind of curriculum giants like McGraw-Hill and Pearson in the space, but now we're starting to see some really large platform companies that have executed both organic and inorganic growth. And, you know, GoGuardian, we see ourselves in that model as well. And from our perspective, our sponsor is Sumero Equity Partners. They've been amazing to work with. But we see a lot of you know, some new names in private equity entering the education market, folks that haven't made big investments here. And from my view, I'd love Jason's take on this, but it's larger and larger funds that are entering and driving a lot of this consolidation, putting more money to work to build larger EdTech platforms.
So Jason, do you want to talk a little bit more about sort of your perspective as sponsoring entering this ecosystem, generally entering the EdTech ecosystem, but also doing it now?
Sure. It's just context. Francisco Partners has been a pretty active education technology investor for a number of years. You know, we've made at this point, gosh, like 20 investments in the category. We have 8 current active platform companies in the category. So this is not a new category to us. We quite like the category. When we started investing in the category, it was really a nascent category. It was sort of one of the reason we started investing wasn't, it's a wonderful sector. I've come to really love it and the people in it, but we started investing, we looked at like size of market, GDP allocated to it, level of technology investment. There seems like a there there. And so we have benefited from, in a great way, from just the growth in digital. We haven't gotten too fussed, our valuation's too high or valuation's too low. It's ultimately, this is a sector that is transitioning rapidly to digital. And I look at today, you know, today even with people talking about, you know, valuations off, like you have a good, healthy business, like we're going to pay you a good, healthy price for it. Ultimately, that's, you know, we're in the business of building great companies over a longer period of time. But the idea that a sector that's mature would start to consolidate, well, like, of course. Like, that's not new or special or different with education. That's been happening across, like, you know, really any sort of technology end market, no matter which one you look at, for long periods of time. You know, look at, gosh, you know, IT security management, look at databases, right? Look at ERP, just you can go to every sort of technology or horizontal or vertical that's more mature, and it does go through a period of like rapid growth and then ultimately some consolidation. So I think we are, in education generally, we are still in the rapid growth period, just to be clear, right? It is still very early. There are some categories of the market that have grown so rapidly and so quickly and have seen such proliferation, such as like K-12 tools and digital content, that they are going to probably have that the consolidation cycle may also compress. That doesn't mean those businesses are damaged or there's anything wrong with them or that they won't. This is not a long-term, secular, healthy, structurally healthy industry. It just may have a period of consolidation. And if you're a private equity guy, you kind of like that. There are lots and lots and lots and lots and lots and lots of other parts of this category which are so early, right? Like this is not a mature industry. And the reason there are 7,000 people here is because there would not be 7,000 people here if this industry was like all ready to consolidate. They'd be like 47 private equity guys like me, and it would be really boring, right? There are 7,000 people here because the industry is really still in its infancy. So I do think this is a pretty exciting time to be in education. I don't think valuations are that low. If you have a great business, love to talk about it. We'll pay a healthy price for it. I think that's where we are in this cycle. It's just not 2021, exactly.
It's certainly not. As an advisor to these companies, I'll tell you, certainly not 2021.
Yes, we're in a community college, thank you, and located near a city. So our proposal is to rebrand career services to career advancement.
Okay, even she agrees it's not 2021. But so moving, so tell me, so Pranjal and Anthony, you guys are in sort of, echoing what Jason was saying. Like you're in the sort of corp dev space, looking to potentially acquire companies, looking at the market from an acquisition perspective. Are there particular verticals you're interested? Are there particular factors you're looking for? Are there sort of hallmarks of a company that you're looking for? I mean, in 2021, sort of like any alive company may have been the answer. How is that different today? What are the different hallmarks or the different characteristics? And if someone here is looking to build a company towards acquisition, what should they be hearing from you?
Yeah, I think that's a great question, and maybe just to add to Jason's point, I think again, look, tech penetration in education is 3%. In retail, it's 11%, and retail is not mature, so tech is definitely, there's a huge scope for growth there. From our perspective, right, and I think each company has their own strategy. I think the way we think about our M&A strategy is we are like a startup of startups, which means the first guiding principle for us is that there is still a lot of passion and fire and freedom given to the founder that's joining our mothership. That's how we see it. Because we ourselves are growing so fast, and that's why I use the word ambition, not consolidation, because for us, it's important that the founder and the founding team that joins us has that same ambition to continue growing and sees us more as a mothership giving some direction and best practices and all of that, but running the show independently for a few years. So in terms of guiding principles, one clearly is the fact that it should be driven by a solid team, and the founding team is invested, and the deal is structured in a manner where they remain invested to build their business. The second thing is our preference is to evaluate the business standalone and consider synergies as an upside, because our learning has been that yes, synergies come, but they take time. So how do you sort of evaluate the business standalone? That's important. Third, flavor of the month, for the season, for the year, for the decade, for the century is profitable. You have to be profitable, which doesn't mean that you have to show EBITDA performance now, but it means that the unit economics is solid. It's not very different from what a private equity guy would also do. But when we look at unit economics, for example, it could be messy. But then we know that we have a playbook to say, okay, I can cut costs here, I can cut costs here, I can cut costs here. And after I do that, it becomes healthy. One of the advantages for us as Emeritus is that we're actually a global delivery model with a lot of our costs sitting in low-cost geographies like India or Mexico. So we know how to offshore costs, how to bring them to low-cost geographies. We know that. We have that playbook. So it's important to look at the economics and say, okay, And I think the last thing I would say from a guiding principle standpoint is be clear of what you don't want to do. I mean, it's more important to be clear of what you don't want to do than what you want to do. So we are a university-backed higher education player, which means we will not do K-12. We'll be very careful of anything which is outside of university partnerships, right? So those are the areas that we ideally don't want to do. And I think that sort of helps us in our sort of guiding framework. Yeah.
Anthony, your perspective?
Sure. I think there's a lot of different frameworks for how a company looks at acquisitions, and whether you're kind of defensive and trying to fill gaps inside your product with maybe features that would help you win against competitors, or more offensive. And I think we're squarely in the camp of at this stage in our company's life cycle of looking at offensive opportunities, meaning where are the adjacent addressable markets that help us kind of grow into new spaces, new product lines that are synergistic with our top line. So we have a huge sales force. We have 25 million students on our platform, and that's one of our unique values to potential acquisitions. Is we can help accelerate your growth and cross-sell you into our existing customer base. Versus, at this stage, we're not that concerned with kind of cost synergies and where can we save money in an acquisition to make it profitable. We're really looking at how we can grow.
Can I just add one thing? I would, on the advice side, I would not set your company up for sale. I would focus on a really strong strategy and execute against a strategy. Because the key question that you're going to get in any type of deal process is, what do you want from us, right? I'm sure Jason would ask you that. What do you want from us, right? And the reality, you better have a good answer with what you want from us. And your answer will be very clear if you already have a really deep strategy and you're at a real point in your actually company's evolution towards that strategy of actually it makes sense to do it. But they'll see right through if you're just setting the company up for sale, is my view.
Right, and I was going to ask you to talk about sort of how your experience sort of, in the build versus buy phenomenon, where you were looking at M&A from one perspective, and then, an opportunity came up where it sort of took you in a different direction too, and maybe sort of just to emphasize what you were just saying.
Yeah, exactly. So we did, in our last deal with BrainPOP and Lego, we did not have any intention to sell the company. We actually had this really large opportunity in consumer. We opened up BrainPOP for free to the world about February 15th, and obviously created a brand new consumer business for BrainPOP, serving families all over the world. And we said to ourselves, that is a totally different business than our institutional business, and this was the right time to actually, raise some money with a minority investment to build out a separate consumer business for BrainPOP. And so our intention was to use funding to actually do a build strategy. We happened to meet Lego in the process, and they had a vision of actually building the biggest digital platform. They want to go beyond the brick and actually build digital education as a massive global where they would serve every kid in the world. So not only would it obviously help us build our consumer strategy, it would actually accelerate the overall vision that the family owners of BrainPOP had. So we quickly pivoted towards a full acquisition, but we didn't go into it with that. We went into it, the fact is we want to actually raise money, but it turned into obviously a full acquisition, and just how that process goes. And we just responded to what was in front of us.
Understood. And I mean, I think the theme that you're hitting on is also when you're thinking about sort of M&A generally, but also this build versus buy kind of, phenomenon. And Anthony, you touched upon it a little bit, so I'll go to you again, which is, do you, when you're thinking about that, what is the strategy, what kind of strategy should you have when you're thinking about sort of building versus buy? Because you said something sort of, you talked about growth and growing into different verticals. That's your business strategy, right? So the business strategy is to grow into different verticals or to grow, increase customers in different jurisdictions or whatever that may be. And when you decide, should you build into that or should you buy into that? What are the things that you're thinking about?
I think for us, we've made that choice a few different ways in the last 3 years. When we've landed on acquisition, when we felt like buying was the right decision, we were really focused on time in the market, and we wanted to execute as quickly as possible to take advantage of some of the tailwinds of remote learning. Maybe we felt like there were product capabilities that would be challenging or take us a long time to replicate. And in those cases, we opted to buy. We bought an assessment company in 2021, Edge Elastic, and a tutoring company last year in 2022. When we've come down on the other side, it's been really about what are things that we can uniquely bring to the table, and maybe ways in which we can build or design a product that works really well with our existing portfolio. In the last 2 years, we've had a skunkworks project where a team kind of worked in secret, building a gamified practice tool that we just launched last month called Giant Steps. And in that case, we were really focused on creating something unique that the market hadn't seen and really plugged into our existing portfolio.
Pranjal, I think you had some advice too, similar, like about talking about internal learning first and how that plays a key part in your strategy.
Yeah, I think, look, so we've done 3 acquisitions in the last 2 odd years, very small to decently large. I think our lessons have been, number one, build conviction. So to Anthony's point, we are offensive. Yes, we are offensive, but then we have an offensive strategy. I mean, we're not offensive, but like we have an offensive strategy. But the offensive strategy comes from the fact that you have to be very clear on what you are buying and what capability you are buying. So for us, the way to test that is to actually seed that idea first in-house, invest in the team, give some capital, figure out for a year or a year and a half, few months, what's the struggle, right? What's the secret sauce? What are you missing? And then you exactly know what are you looking for when you're going on the offensive, number one. Number two is, there's a lot of literature around M&A failures. I mean, some say it's 60%, some say it's higher, some say it's lower. But I think, again, our lesson there is, and I keep coming back to that, is extracting synergies is not easy. So what it means is either you invest in the capability of extracting synergies upfront, which for a startup or a high growth company like us possibly is some distance away, right? But like for financial sponsors like Francisco or the PE house, they know in and out how to extract synergies. But for us as a company, we still don't as much. So then it means either you build that capability or else you don't count on that capability when you're doing an M&A, number two. Number three, I would say, which I think goes back to what Scott was saying, is it's extremely important for both sides to be aligned on what the future roadmap is. I mean, I can come in with a term sheet and say, you know what, this is how the term sheet looks like, these are the 3 milestones, and you have to achieve it, and blah, blah, blah. But at the end of the day, if the company's founders and if our founders and if the leadership is not aligned on the combined roadmap and the business plan, it's a disaster. So you have to really, really, align on that beforehand. And hence, in that sense, it's all about conviction, right? So team is great, the roadmap is aligned. Yes, we are clear on what we're buying. The target or the company is clear on what they're getting as a benefit, like he mentioned. Once all of that is done, then I think M&As work. If any of those are not there, it means there is some failure that we'll have to mitigate.
And Scott, you were nodding away. I was going to go to you.
I'd love to bit like this is really good because I think the most important things to have success, first of all, it's that alignment issue, and I think everything you said about it actually starts with culture alignment is critical, and really test that early. You know, that old adage, culture eats strategy for breakfast. It's real, right? And values alignment too, other than the business plan, because values is really how decisions are made. And if you actually don't have that values alignment, you're gonna lose all the innovation that the company ever had, because you're gonna have massive, retention issues. So that's, I agree. And the synergy one's another interesting one that I have a strong perspective on as well. Is I love peanut butter and chocolate better than anybody, but when you try to smush that together, it never works, right? Like, allow the company to still thrive, right? Don't force synergy on it. Let it happen organically. If you let it happen organically and don't push, like you said, I wait. And as soon as you start talking about all the synergistic ideas right away, guess the management team is totally not focused on hitting their plan. And that's the same plan that you sold the company on. So the ability to actually, really not allow synergy to happen organically is so important, what I would say to add to you.
What I would say on that is, totally agree. And a really good framework for it sounds really simple, is what is the best thing for the customer? Like,
yes.
Just think about that. And actually, like, if you think about that, you will likely have alignment with your customers. You will likely have alignment with your teams, and you will very likely have alignment with your investors. I mean, like, ultimately, as an investor, very few investors, maybe except for yours, are in the own forever business. Right?
They are in the own for.
They are in the own forever. That's uncommon.
No, I
right?
agree.
Like, public companies are not in the own forever. Like, most, unless you're like a dynastic family, you're not in the own forever business. So really what that means is, like, your investors are ships passing in the night, and your investors work for you, period, right? Because ultimately the company is going to hopefully be living and thriving and surviving way after those investors have moved on. And so if you try to orchestrate your business to demonstrate synergies or to like hit some metric that you think some guy on Sand Hill Road's gonna like, it might work, but it probably won't. And like, that's why I think that's one of the reasons that, like, 60, 70% of strategic M&A ends up failing. So, like, the last thing an investor wants to hear in a pitch is all the buzzwords that you think investors, or you might think investors, want to hear, right? We want to hear, like, alignment with customer, alignment with value proposition, and then again, how can we help, right? Because if you're point A may be here, and maybe here, maybe here, maybe here, right? We want to know where's point A, where's point B, and because if we get from point A to point B, we're going to do well enough, the company's going to thrive, and that ultimately is the goal. It actually, like, sometimes it's complicated to do, but the framework of it really is that simple.
That's really interesting, and you hit on something in the middle of that, which is that we now actually have 2 minutes. No one else is telling us. And
2 minutes.
I wanted to spend just 20 seconds from each of you saying, is buy-side M&A accretive to shareholder value? I mean, from each of you. I mean, you're all on the buy side, so I want to know, kind of like, what is the one thing you'd caveat by saying yes, but only if? Any of you can start. Sorry, I don't mean to put Jason on the spot.
I mean, I have a simple thing for this. I think definitely yes, but you got to do it right.
I would say definitely yes, if the buyer's strategy aligns with that need and the seller's strategy also aligns with that. It's important that it happens on both sides.
Just +1, yes, but there's got to be alignment.
Nothing to add.
Okay, awesome.
You're all biased, by the way.
Yeah, I know. It's
You're all biased.
One day we'll talk to the people you acquire, and then
That actually would be an interesting panel.
Yeah. Well, with that, I think we'll keep that panel for next year, and we'll see if we can sort of mix it up a little bit. But thank you for your time. I'd like to thank all the panelists, and thank you for the conference organizers.